Absolutely. Good morning, and I'd like to thank everyone for joining us for the January 3rd Thursday marketing meeting. We're going to talk about the conditions of the markets, what we can do, what's out of our hands, and probably take a little bit look forward into what some vague ideas that we have for new crop. We're just off the January WASDE, which is typically the biggest and most important report of the year. So why don't we kick it off and talk about some balance sheets, Brooks? How does that sound?
Well, I guess we're going to start off with just news. I would say we got to do something energizing with good news, but I guess we'll go to the balance sheets. That sounds like a good start.
We have to start somewhere. And yes, we don't have a lot of good news. That is the reality of it. But this is also the situation where crop insurance becomes more important. This is, we have to deal with the reality the way it came and not the way we hope and would like to do. And that is how we help make money, when things are a little on the edge here. So, starting with the corn balance sheet for January, it came in with an ending stocks number at 2.162 billion bushels. That was 31 million bushels higher than December. It was also, more importantly, a little bit higher than what the market was expecting. Most analysts were grouped into a block that basically saw that number maybe running about 50 million bushels lower. And when the number came out a little higher than expected, that did create a bearish reaction in the market on report day, prompted a fair amount of fund selling, and that has pushed us into a new lower tier for pricing. What is driving this? Well, first, yield per acre. The USDA bumped that up noticeably, 177.3. That added to production, even though they cut the acres harvested down a little bit. When you cut those harvested acres down, that tends to push the yield numbers up. So we actually saw production go up a little bit. The bottom line numbers, they didn't really change too much. They did push up the food, seed, and industrial on a little tiny bump of ethanol. Now, this ethanol number probably is not going to get any bigger anytime sooner. In fact, it's probably never going to get bigger. So the demand side of the equation is pretty well set. They did nothing with the export number. Brooks, what do you think about corn exports and this idea that we're going to be at 2.100 coming in for the balance of the old crop year?
Sterling, I heard my name called and I had to answer a quick call, but I think you're on exports there. And the discouraging news, I think if you talk to those that actually conduct these export trades, they're going to tell you that 2.1 is an aggressive number. And of course, anything we subtract from there goes straight up there to that top line and ending stocks. And really, Sterling, you hit the nail on the head. I mean, obviously we talked about the yield changing, but as far as a game changer from this point on, and we talked a little bit about this yesterday, it's got to be in this category right here. It's got to be in the export category. I don't see any surprises with our other two big usages there when it comes to our domestic feed usage, just a couple lines down. Don't see a big ethanol change. If anything, ethanol is lower than the 5.375 billion rather than higher. Not a good thing. Excuse me. Our surprise is going to have to come in that export line. And right now, it doesn't look like that there's going to be a surprise of increased usage. Instead, the surprise may come with further cuts to exports.
Yes, that is the most likely outcome. There are some things maybe that could push exports up. If we see some increased Chinese demand as they want to increase their feed supply to push domestic food prices lower, that's one thing that could potentially help us. Mexico's imports have been good. They've been a solid buyer, and that is something that has been something that we've been able to count on. Chinese purchases typically come in the month late February into March, maybe stretching into April. So there is still that possibility on the table that we could see China come in here and buy it. As far as the rest of the world goes, I don't see anybody else really clamoring for a lot unless we see some surprises come out of Northwest Europe.
Yeah, Sterling, let's stop right there because I think we've stayed on top of geopolitical, issues over the last couple of years. I think back to, I guess it was, is this right? 2 years ago, we had the special report in late spring on Ukraine and Russia.
Yes.
Seems like it couldn't have been 2 years ago, but it was. Let's talk about some things going on in China right now, and I'm going to inquire more than I'm going to inform. And if anybody on the call has got information on this, I believe I keep I keep mainstream media at a distance, but I also keep it up as background noise during the course of the day. Yesterday, I believe I saw a quote out of President Biden saying that we did not support um, an independent Taiwan. We've got a presidential election coming up. Is there any waves there? I mean, I don't think there's any positive waves there by any means, but what would we be looking for if there was a situation there over the next 8 months?
Well, my opinion and what I've been able to gather from my sources that are pretty well respected outside of just what comes over the news media is that Taiwan may be more of a strong man for China to use as a bully pulpit and as a tool of leverage rather than actually engaging in any sort of attack on Taiwan. Essentially, Taiwan is a small island. They make microchips. That's what they do. And Taiwan Semiconductor is obviously the world's largest supplier of those chips. I think China has figured out that rather than take on all this political and economic problem that attacking Taiwan will bring, they're going to be more inclined to just make their microchips themselves. That seems to be where their industry is leading and pointing. As far as what Biden thinks about Taiwan, it is what it is. The question is, would we engage in tariffs, sanctions, or other things to stop exports going into China? Which, if we did that, obviously would be, for a certain period of time, detrimental to prices. That is, some of the political risks that we have coming into, and the geopolitical risks have actually probably moved from the Ukraine and moved right onto our own shores. So, depending on how the presidential election works out, the situation is if we see one party win, we will probably see some degree of firmness against China, which would be, for over the short term, detrimental to prices. We would see a bounce and a recovery, much like we saw the last time we went through this. However, there was an unintended consequence of that. And that unintended consequence was Brazilian soybean production. Brooks, how big is it going to be this year?
Well, that's a big question. Early on, and I know we talk in million metric tons when we talk about Brazil. Let's boil this down into bushels, okay? Because I think most of us on here are going to make that comparison. So initially, pre-planting, the estimates were for Brazil to produce around 5.93 billion bushels of soybeans. Okay. We all know there were some issues early on. We had some dryness in the north, a little bit of excessive moisture in the southern third of Brazil, and those estimates have come down. How low are they? Well, we don't know, but they're somewhere probably in the 5.5 and a half billion to 5.63 billion market. CONAB is a little bit more pessimistic than the USDA is. Nonetheless, I think everybody can agree there's 250 million fewer beans, all the way up to maybe 380 million fewer beans coming out of Brazil. So
versus this year's exports, that versus this year's production ideas.
Yeah.
But if we look back to where we were with Brazilian production in 2020, Brazil has taken an enormous amount of land. Picture the state of Kansas, that much of pasture land, not rainforest, but pasture land. And they're turning that in, they have turned that into farmland. They have
That's a really good point. And so, you can afford to lose that 250 million if we look at where they were at over the last few years. So, we saw it really, I think, last year, didn't we, Sterling? We saw that big land increase last year.
Yeah.
And Sterling's making a great point. A lot of you have probably been down to Brazil. And yes, you can add a lot of rainforest. Can you add a lot of bushels? Not very quickly. You get down into that Cerrados area where the rangeland is being converted over to cropland, and there's reservoirs being built for irrigation. You can change things a little bit quicker on the balance sheet, and that's what they've done. It will be interesting whether this decline in beans escalates the introduction of beans into pasture land as fast as it has. Common sense would say it would not. We will see.
Well, we're not dealing with common sense here. Remember, we're dealing with the Chinese. The Chinese do not think in terms of markets, necessarily in prices, as much as we do. It is not a market-driven situation. This is a situation where the Chinese government wants to secure their food supply, and Brazil is the source that is being funded and what is driving this. So if we take punitive action against China, we will get immediate gratification from that, but we will get structural changes in the global soybean market, meaning once this is in place, those beans aren't going to go away. So even though we are seeing, a slightly smaller than anticipated crop, you can take this to the bank that we are going to see record soybean exports out of Brazil regardless.
Yeah.
And that number will get bigger. So that is a situation where handling China, you can think about the immediate gratification, but remember, with any policy, there are unintended consequences. And one of those unintended consequences of the tariffs on soybeans in China was that Brazil was able to amp up their production relatively quickly and relatively easily.
Pretty amazing whenever you look back to see what they've done. I think most of us in the late 90s, we saw the Brazil as this looming soybean production giant. I think the first time I went down there was 2001, and I came back and thought, it's going to take them a long time to step up their game. They were 20 years behind us in a lot of areas with technology, and wow, have you seen that ramp up so much over the last 3 years? I would have never thought we would have seen the increase in acreage and production down there in the last 3 years that we saw.
Throw plenty of money at it. Technology is very easy to access.
One of the unintended consequences here too, Sterling, you bring that up, is I know you touched on acres on corn last year at 94.6. We're going to take that number down. The question's how low, and I don't want to transition from bad news into bad news, but any acre that we decrease on corn is more than likely going to be switched right over to soybeans, exasperating the problem even further.
That will create, and I'm trying to work on these balance sheets and coming up with some acreage ideas. And for one thing, I think the low prices, and right now we have new crop corn at 472 and a quarter, and old crop at 438, making a new life of contract low. Marginal corn acres probably should be idle to help take some of the edge off of what prices are driven largely by production. Demand, we understand, we know. For most of it, the exports are the big variable. We're going to need to see acres idled when they're marginal. Good corn acres will get turned into good soybean acres. There's absolutely no question about that. And we need to ramp up our exports of soybean meal. And we need to, obviously we have some new crushing capacity coming on. That's something that will help us a little bit. And again, then we have to think about, what Argentina, who's a big soybean meal exporter, what they're going to do and how that is going to affect meal exports.
And a good crop in Argentina this year, especially versus the last two. moisture, more plentiful than it has been in probably 30 months down there. So expect pretty good production numbers out of Argentina.
Yeah, and here's where I can inject some good news. We are moving through the El Nino cycle, and my advanced weather people think that by the time we start moving into South American production next year, we will be moving into a La Nina situation. La Nina has particularly adverse effects on Argentina. And if we can see that happen, and we see Argentina not able to export as much meal, that's something that could help provide some support for the domestic soybean situation. The other thing that is, well, here, let's go ahead and switch to the soybean balance sheet here.
Yeah, we kind of transitioned the conversation that direction anyway.
Yeah, because corn, the corn situation is what it is. The variable in the equation is going to be what we do with soybeans. And the January WASDE pushed soybean ending stocks up to 280. This caught the market off guard noticeably. I actually had an idea that we were going to see, and most analysts thought we were going to actually see that 245 number cut somewhere to 215 to 235. We were not looking for this big jump. But again, here, yield per acre bounced noticeably, and production went up, and that went right back into the ending stocks number because exports and crushings, the two big things, didn't move. The crushing number next year can be a little bit bigger. We have new capacity coming on. Maybe we can punch it to 24. Maybe if we can export the meal.
You know, Sterling, that export number is disappointing. And if you draw one common denominator, I mean, obviously these yields up didn't help things, but China's absence from the marketplace for U.S. corn and soybeans is probably the common denominator on these balance sheets that's really brought us to our knees, along with that South American production. There's never one variable out there.
Yeah,
but if
Brazilian production was substituted for American consumption.
Yeah,
that's exactly what happened.
Pretty simple to see what's happened. Will China step in and buy more? That's always the question that nobody has a really good answer to, but it is not looking good at this point in time.
Here's a piece of trivia for you, and I picked this up yesterday. China's population declined by 2 million people last year. What?
Not a good thing.
The incredible growing Chinese population shrank. It did. And the Chinese government is trying to incentivize Chinese having more babies. They are trying to do that, which in turn, in time, could, help increase their food demand situation and help increase that. But that is a long way down the road. Chinese hog production has also increased noticeably, meaningfully to drive down hog prices, to keep food prices low. And that's something at the margin can help us, and especially if that can become more entrenched. And if we see lower food prices in China, household budgets, which China's a weird place. The government tells everybody what to do, but the regular household has to make it work just like the rest of us. So we could eventually see the need for those prices of food to stay depressed, and that in turn would be good for Chinese imports of all items and hopefully help our balance sheet out a little bit.
All good points. In practical terms, what does a farmer do here? And here's where we're stuck. As February and March approach, farmers are going to have cash. I think January, if you put a red, yellow, green on this thing, we're in the yellow range right now. They're okay. They've got cash to operate on. But in February, March, a couple things happen. One, there's going to be a lot of bills that come due on the farm. Two, old operating lines, they're wanting to get those cleaned up and write new operating lines, usually by April 1st. These operating lines, folks, aren't what they used to be. I mean, I'm hearing some rates In the northern states, in the upper nines, all the way down to the mid eights, if you come down into the Midwest, as far as rates go, they've got to have cash, and this is where it's tricky. And we don't have good solid alternatives to go to other than just selling grain. And you hate to sell grain when Sterling's pointed out that corn's at contract lows and not finding any support. So let's talk about that for a second. Really and truly, what are their options out there right now? Now, 90% of farmers, they don't like to use derivatives or options. So, a couple alternatives. One is they can do what we've been suggesting for 3 months, which has not worked, and that's basis contracts, waiting for some type of market pop. And you say, well, why didn't you sell 40 cents ago? Folks, when you look at a chart and when you look at the opportunities that this market has given farmers on corn, literally, I think we could go back, and if you gave us a magic marker, we'd circle 2 times, one in May, in late May, one in early June, whenever the market had signs out there that was saying, Mr. Farmer, sell the crop. It was incredibly tough to pull the trigger back then because of the weather conditions we were experiencing. But over that time, when we talk about contract lows, we can't say contract lows were present. But Sterling, if you've got a slide that shows that December price action, you can easily see why there's not a lot sold. So basis contracts haven't worked. So when you step into it in a strictly an options market, there's a couple of things to do. One is buy a put. And it's not advice that I would have given over the last 6 months because a put costs money. And you're talking about lowering your floor to probably 20 cents under the current market. And that doesn't give you a lot of time for protection. That's a great look at what farmers experienced this year. If you look at that chart, that is just it's crazy. And Sterling's going to add some RSI down there at the bottom, which correlates with our action indicators, but not a lot of opportunity in that chart. I mean, Sterling, we've seen this kind of thing before in your history. And you have to, a 2008 scenario, I think, was one where we saw prices fall precipitously from February all the way through harvest. What's another year that comes to mind?
Oh, another year. Well, the post-drought years, 13, 14, 15.
Yeah.
You had the big run up, and then prices came back down to what is a more typical price. And we are enduring that right now. And the problem with the situation relates right back to that corn balance sheet and the global balance sheet as well, which is noticeably fatter. There is no urgency to buy. When a futures contract trades, there's a buyer and a seller. Well, and then you hear some people on the mainstream media, well, there's more buyers than sellers. That's wrong. There's always a buyer for every seller. What drives the futures market is an urgency to buy. You need to buy. I need to buy this corn now because I need to turn it into cornflakes. Well, that's not happening because global supplies and threats to global supplies are not really that present. We have the ability to export, even though we have some minor handicaps. We do have the ability to get the corn to China where it's going, and mostly into Asia, which are the bigger buyers. Now, we do have some things here that could reverse this, and that's the situation in the Middle East and the problems in the Red Sea. That is blocking shipping, and shipping prices are going up. Right now, it is mostly affecting goods prices and things coming out of Europe, and moving ships around is creating a problem. If that were to create a bigger problem, that's something where we begin to drive up shipping costs, there may be a little bit more urgency to buy. But right now, until that changes, gravity has got a hold of this chart and it's got a big grip on it. There's no aggressive reason to step in here and buy corn, and no one's going to be willing to buy any more than they have to. So the path of least resistance is lower.
Sterling talked about primarily fundamental variables in the marketplace. I know this is really challenging to see on the screen, but if you do look at that RSI, or that relative strength index at the very bottom, you see a couple times there, you see some shades of red on the left, and only a couple times do you see shades of green as you start to move right. Okay. Now, the two opportunities I referred to, that shade that starts off on the left, that's November of 2022. No,
That is, this
20,
right here is April of 22.
April of 22. So we're talking almost 2 years ago. Okay, that correlated with a little bit of the Ukraine situation that we talked about earlier. When you move further to the right, the two pops we had in May and June, really challenging, and they're short-lived. If you really look at that, you break that down, those aren't weeks of opportunity, those are days of opportunity. And when you look down right below that at RSI, you see RSI dip below what I think Sterling's got a line drawn at about 30. Is that right, Sterling? That green line's around
Right
30.
here. And
Yeah.
we launched out of the hole and we got a pop. And RSI it's an interesting indicator. You clearly get the deeply overbought. But one thing that I look at, and I have the ability to make this into a giant, where the RSI is the only thing on the screen, and looking at it, sometimes a shift in momentum in RSI, we don't get quite oversold. As you can see here, we didn't get oversold, but we saw this shift. It can lead to big precipitous moves.
Yeah.
And that's something we pay attention to. And what I put in to the a new addition to the action indicators, this is a stochastic. This is a pair of oscillators that also measures overbought and oversold. And what this does, when you begin to see these reverse, particularly if it's not all the way up here to overbought, this can be the indication of a very large move. And as you can see, this clearly predicted that downtrend coming into place and made it up very closely with, with the RSI starting to get into an oversold situation.
So let's put a positive spin on this right now. In theory, when you look at that vastly oversold number, okay, I think we're going to be looking at RSIs in the low 20s today. Sterling in that ballpark, 21-ish, 22.
We're 25.53 right now.
25. So we're down there below that green line, and you can see it doesn't spend a lot of time down there as well. Let's hope we've reached that oversold position and pop that back up to something at least a little bit neutral here shortly.
And something about technical indicators. Markets need an outside impetus force this shift. Right now, the biggest short in the market are obviously speculative funds. We made a new life contract low at 436.75. This is one of the few things I can say with complete confidence about a futures market. At a life of contract low, all shorts that started the day are profitable, meaning there is money made. Now, something that could help produce a pop. We're beginning to come into a period of risk. We have planting risk, we have acreage risk, and things of that sort that could inspire some fund short covering where they come in here and they buy this and that produces a pop against a market where it's oversold, meaning the sellers don't have a lot laying around to sell. And this pop right here, this is 3 days, folks. We built up to it, we exploded, and we caved right back in. 5 days of activity right here. This is something that could potentially happen. And something I do in my own stock trading and other things is I put in something called a stupid bid or a stupid offer. Meaning right now corn's at 437.25. A stupid offer right here, 463. Put an order in there to sell it. Leave it in good till cancel. Make sure you cancel it when the contract rolls over. We get something stupid. That happens. And stupid doesn't last very long unless it's running for political office. You get that pop, you might be able to find yourself in a little better situation. And one other thing I'd like to point out, and this has to do with marketing. No one's going to be perfect. And I have a beautiful example of that. The first purchase of pizzas with Bitcoin was made by a gentleman who took 25,000 Bitcoins and bought 2 Papa John's pizzas. 2 lousy pizzas. I lived in New York and Chicago. I know how good pizza is, and it's not Papa John's.
Oh, you just broken a lot of hearts in the Midwest now, Sterling.
But hey, demand better. Anyway, the value of those 2 pizzas, current Bitcoin, the man bought 2 pizzas for what is now worth $440 billion. So you're probably not going to screw up that bad.
Sterling, most of my comments on here are pretty conservative and laid back. And I didn't finish the conversation on marketing, but a put option to me doesn't look like a great situation to go into. It costs money. It lowers your floor. Pretty tough when you look at this chart. Having said that, that's exactly what you should have done over the last 6 weeks when I said it wasn't a good idea then. A call option and making a cash sale, that's always viable. Most people are going to buy March calls, which gives you protection next 30 days. Sterling and I don't see much there. But
Now,
this is where I'm going to go off script a little bit. I'll tell you a story. As a student at Murray State, Thursday nights, of course, party night at a university, and the professor says you will go to hear an extra credit lecture on Thursday night, and so the class shows up for the lecture, and I really thought at the time I didn't see the meaning, like so many things, but I see it now. And essentially, it was an economist, and the economist used history to show us how economic conditions oftentimes write the history book. We want to say it's good and bad characters in the world and different things going on, but many times it's economic factors. And Sterling said something earlier, for every buyer, there's a seller. And for everyone that is celebrating, there's someone with their back against the wall. And when we see extreme movements, whether it's in equities, whether it's commodities, we create that volatile situation. It's not just volatility in the markets we look for, it's a volatility of how people act and react to certain things. If there was one indicator, according to this guest speaker 30 some years ago, it's this massive situation we've got where someone's got their back against the wall. It may be crude oil, it may be food inflation. There's so many different things it could be. It spurs unrest, and Sterling has alluded to that a few different times today. It may take something geopolitical, it may take something global. Of course, we don't want that to happen, but it can change these charts in a big way, in a big hurry.
yeah, and that's something where we look at the situation in the Middle East. Right now, February crude oil is at $73 a barrel. The situation that started in the Middle East 103 days ago, crude was sitting at $83 a barrel. We're down $10 a barrel. U.S. production is at its highest levels ever for producing crude oil. And that is something that translates into a problem for the soybean market. As you always crush for meal. You always crush for meal. That's what you do. Well, that's changed. And we had noticeably higher soybean oil prices, meaning crush margins were noticeably better. Well, as we've managed to take and tame what should be a very volatile period for crude oil into a much more tamer situation, that has taken some of that premium out of that soybean oil, which is a new feature in the soybean market. In fact, here we're going to go ahead and put up a generic chart of soybean oil, and you can see what we have going on here with the bean oil. And this is soybean oil. Going back, see, we had bean oil prices noticeably higher, corresponding with that higher crude oil. And that has come in and weighed on crush margins, which in turn If I can't make as much money crushing soybeans, I'm not going to be as willing to pay for soybeans. So I either let production ease a little bit, or I sit on my hands until the seller, who is the one with the back against his wall, sells me beans at a lower price. And that is another new dynamic that we have in the market. If something were to go on to noticeably affect the oil market, meaning shipments out of the Middle East, and there is that potential to situation in Yemen and the Red Sea, that's something that could produce a spike in crude oil. That in turn would be something that would be supportive of soybean oil prices.
Always something to look out for there. Sterling, when we talk about getting back to that cash flow situation with the farmer, I think we have mentioned the last couple marketing meetings. It looks like beans were the commodity kind of live off of over the coming months. Let's take a look at that bean chart, because as a whole, farmers have done a better job of marketing beans. And when you take a look at this chart, it's easy to see why they have. I wouldn't say lots of opportunities, but many more than corn. And Sterling, can you punch up? You've got RSI on there. I really like that RSI chart at the bottom. Again, it indicates some opportunities were there, and in many of the places in the country, basis is strong. We talked about crush margins. Now, Sterling, we talked about this a little bit. Crush margins are down substantially, but still relatively good. Can you talk about that for just a second?
Crush margins right now we're at 98 cents, and they were noticeably elevated. We were pushing right around $3 when soybeans were trading up here north of 13 and a half. And that was an extremely good situation, but we had noticeably higher meal prices. Meal was running, $4.40. Right now it's at $3.56. Soybean oil running at 70, 72. That creates a very good crush margin, meaning the crushers of the world are happy to pay for the beans because they're making money. That has come back noticeably, and I think I can make you a chart of that here real quick. Let's try this first. Let's see.
Sterling, while you're pulling that up, one thing that we talked about during the WASDE report, and when we get back to that bean chart, I'll talk about it a little bit more. Remind me to go back to this about fund buying of soybeans. But go ahead. I think you've got a really good chart up here on crush.
Yeah, this is spring crush, and this has always traded below what the nearby crush this fall traded at. But the nearby, we were sitting up here at $1.60 for spring. We're down to 98 cents. And I think here I can get a chart popped up here real quick of what we looked like. Okay, this is fall crush coming in here. And we got yourself a little peak right here for board crush, running right around 251, which is the best we had seen going back for a very, very long time. And yeah, this looks a little more volatile than it actually was for a crusher because this is a board crush and months roll over and things.
Yeah.
But again, we have taken those margins down. They're still very good by historical standards, but they are noticeably lower.
So back to the Nove. Well, I don't know if you had March up there. I think you had March beans up there was the last chart you had. And I hate to keep jumping around, Sterling, but we're in better shape nationwide on beans. And Sterling, you mentioned a number on corn as far as being unsold in the country. Number was close to 10 billion not long ago. 10 billion bushels of unsold corn. Do we have an estimate on unsold beans in the United States right now?
That I don't have right off the top of my head, but soybeans tend to get sold in a hurry. You harvest them. We see big loading advantage. They want to get them exported. Beans don't store as easily as corn. Those move out first. We see the big bump in inspections and exports. We're now past that. Now, there is a flat spot in the bean market when we get out, typically out into July. There's not a lot of U.S. supply sitting around. There is typically Brazil and Argentina have pretty well moved those. That's a spot where if you have the good fortune to be able to have some beans around, you may not see great board prices, but you may see spectacular basis prices if we're seeing good exports of meal and pretty good crush demand. This chart right here is actually the generic crush, and we hit a peak at 355, and as you can see, we're now down to hanging around right around the dollar. So let's put up that March bean chart. Let's get this up here. Put an RSI on that. We can take a look here back to what the beans look like. Did you want to look at March or November?
March is fine. They're going to tell a similar story here, but you can see how much it differs than the corn chart. And there, when we look at RSI at the bottom, and we look at it above 60, Sterling indicated that really in this marketing year, and we're going to say last April until today, I think Sterling indicated 5 days of good selling opportunity as indicated by RSI over that period. And you can see beans had a lot more. Plus, to Sterling's point, one load of beans generates a lot more cash than corn when you're going to the elevator. I think folks lean still pretty heavy on beans for cash in February and March because of the oversold. While beans are oversold, it certainly looks like, if we look at this, and we got some produced, but we've crossed that green line at the bottom, and you can see beans don't stay that long below that line. Now, Sterling, why in the heck is that? You talked about this in the WASDE meeting. If someone is paying you to trade beans, you've got 280 million left over. What gives us a little bit of hope here on soybeans?
Well, first of all, 280 million is not 2.16 billion. 280 million is a little bit of a heavy bean supply. It's not that heavy. It's not just inherently just not that heavy. Global soybean supplies are generally tighter. The urgency to get the soybeans exists. That's why soybeans are much more volatile. And if we look right here, right now we're sitting at 1206 and a half. You can see right here, that's major support. And we are getting, some pretty good oversold readings. Now, if I'm sitting on Wall Street and I sold beans up here and I'm pretty smart and I sold them, $13.75, I've got, $1.70 in these bean contracts that I've sold. We've had some beans sold here recently, right down in here. Those aren't as profitable. And that's actually a good thing. Because if I don't have that much money made and something happens to spark this, could be, new concerns that Brazil isn't going to produce quite as many. Maybe Argentina, farmers are going to sit on it. Anything that produces a spark here, we have a combination where we have some pretty good kindling of where funds are short and not as profitable, meaning they can't be as lackadaisical. If I only have 40 cents in these beans, I'm going to be awful careful with my 40 cents. And it doesn't take a lot of aggressive behavior to make this bean market explode. Here today, this day right here, going back to the 16th of June, clearly we had a situation where we gathered support, and it happened real fast. And again, here we're talking about 7 days to get the very best of this. Came back, dipped, failed, and had a little bit. So again, need to be on our toes here. This is where paying attention really, really matters, because these opportunities were not in a bull market. Bear market rallies are inherently short-lived. And this is where we need to be really paying attention and need to be, well, this isn't the greatest price, but right now at 1205, put in your stupid offer, call it 1275, 75 cents a bushel matters.
Yes.
And it's entirely conceivable with one little spark, we could put 75, 80 cents in a soybean market in a day or two. Very easily.
Sterling, we've got a question that comes in, but before I get to the question, I think you said something that was pretty profound yesterday. We did a little marketing update. And for years and years, a lot of people traded a corn and crude spread. And there was correlation there. When I say that, I'm talking in the 90s and the early 2000s. You said something yesterday about now crude oil having as strong a relationship with corn as it does soybean oil. Mention that one more time, because we talked about Middle East, we talked about crude oil situation. How does that correlate to this chart and soybean oil that we're looking at?
Soybean oil and the use of biodiesel has increased noticeably. There are government mandates driving this. And that is a good way to help cut foreign dependency on crude oil. It also simultaneously provides a price support for the soybean market. So if we again see some concern about global oil supplies, and we catch the crude oil market sleeping a little bit and it pops, it will pop that soybean oil market up. That in turn, obviously, the beans are the feedstock, just like crude is the feedstock for gasoline. That will make those beans more valuable. It will improve crush margins quickly. And that in turn should prompt some buying and production to be a little more sustainable, a little bit better. And that's one of those things that could be a potential spark in this market.
So Sterling, you mentioned that, and Jody, I got your question on here, and it's interesting that I don't think Sterling's read this, and he kind of talked about that stupid offer out there. Jody's question to us, Sterling, is there a gap left on the chart on March soybeans around 12.95? Any chance we could fill that on a plain technical bounce?
12.95 gap. Let's see where the 12.95 gap is. The Board of Trade parlance is that all gaps get filled eventually, but that's also done on a perpetual chart. That's the caveat. Doesn't mean necessarily
Tomorrow,
a given
right?
futures contract will do it. I'm looking for this 12.95 gap. Where is that gap at 12.95?
Jody, if you can add something on there, I'm guessing that you got to be close right in there. It's hard to see your prices over on the right.
Let's see. I'm going to put in a horizontal line. And 12.96. So that's 12.96. I'm looking for a gap. Oh, it's right there. I see it. Right. It's itsy bitsy. And so that gap is here. I'll make this bigger. You can see the gap right there.
Yeah.
Gap we go. And that, if we were to see a near-term spark on the March futures, meaning we need to see it now, between now and the end of February, that gap would be an area where if you were long, you would sell. If you were making money, so that would be an area that could be potentially hit or filled, or even getting close, which again gets us to right here, again, that 12.90 area, 12.85. And again, we're not trying to put the ball in the hole here when we're trying to fix a problem like this. We're just trying to do better. So somewhere in that area would be a potential where we would see a market bounce to. That is very good observation on that as well, because that gap is not very big. We're from 12.90. The low is 12.96 3/4. And the next bar, the high and the next bar is 12.90 So it's a 4-cent gap. And you can see if we go back here, we have another gap right down here, and we have come back and we have filled that today. So that may be a little bit of something, because I have to think these fund shorts are probably getting a little itchy down here. You've got money made and you know there's risk coming, particularly to the soybean market. And corn, that risk is not so enhanced simply because supplies are so cumbersome. And I know no one
Well,
likes to hear
I think that stupid offer that you talked about, I think that, you could kind of put a little objectivity behind it. And I know you said 12.75, throw it up there a little higher to that gap. I think that's
yeah.
especially for somebody who's got a fair amount of beans already marketed. And I think a lot of farmers do.
And remember, you don't have to do this in absolutes. If you have the equivalent of 10 futures to sell, put 3 at 12.75, put 3 up a little higher, and then the last 4. And one thing, no one likes to hear cheering about higher crude oil prices, but we want to see higher soybean prices. That's probably your best vehicle right now. Crude oil has sharply reversed just in the time we were having this meeting. We've gone from about 12.10 a barrel to 72.10 a barrel, 73.22 in just the last few minutes. So something is going on to wake up the crude oil market. And again, that market is entirely news driven, and it's going to take, something to spark it, because we actually domestically have kind of cumbersome crude supplies right now.
Sterling, I'm looking at our audience today, and I don't think we've got that many heavy in the South. Is there anything going on in the cotton market while you research that? I think we got a lot of folks from up north, so we don't want to spend a lot of time on it.
The cotton market, actually, I'm seeing a bifurcation in the charts. The old crop charts for March and May don't look really very good. They're trapped in a box. The December chart, on the other hand, has developed a little bit of a bullish tone. And I noticed Jody here had a question about resistance in the dollar index. We're going to do the dollar here real quick, because that applies to everybody. And as far as resistance, we have a little bit of resistance right here. But, we have, this is a goalpost pattern. Down, make a fresh low, bounce, pop up. You confirm within the next 2 days. That is an incredibly reliable bullish pattern. It's, when you see it, I can't guarantee it works all the time, but it works most of the time. And the dollar index, as you can see, we're just getting fresh buy signals. And we actually have an RSI that points to things going higher, meaning we bounced up from oversold and we're beginning to trend higher. So this is a potential for the dollar to rally. What sends the dollar up? Higher interest rates. We've had those the last few days, and noticeably higher. Interest rates today, they're a little bit mixed, but we haven't had a lot of news. Global instability tends to be bullish for the dollar, because people tend to flock to the dollar as the currency of choice, as opposed to some other choices. Today, we're seeing an okay stock market, so we're not seeing a lot, but the dollar is showing some bits of resistance. Talking about the cotton market here, let's look at March 1st. We'll look at the March cotton market. And as you can see, we're stuck. We're doing a little bit better. Here we had that goalpost pattern again, but it didn't confirm. We didn't trade higher, so it floundered. We have a little bit of a mild buy signal, but most likely we're going to be able to find resistance up here. Probably, we're at 81.99, 82.50, 83. The December chart, though, the look of this is actually, I think, one of the more interesting things we have going on. This chart actually is showing some signs of trying to develop a little bit of bullish strength. And some things that could help out the cotton market: fewer acres. That would be the number one thing. Increased consumption. And this can come from anywhere of apparel items. Apparel consumption has been, post-pandemic, awful, just awful. And eventually clothes do wear out. And at some point, maybe people are going to get tired of wearing sweatpants everywhere. That's something that could potentially help this market, assuming we can avoid a recession and a few other things. So I do see this chart as being something that's performing a little bit better than the other ones. And that's something that maybe down the road is something we could look forward to. And the indicators here are, reasonably bullish. I don't think we're going to go to 110, but we could maybe get to 85 90 on the new front. The cotton balance sheet. Did you want to go over the cotton balance sheet, Brooks? I have it.
Yeah, we probably ought to. I don't want to spend a lot of time on it. Like I said, I don't think we've got a lot of folks from down south, but just in case, we're entering those projected price periods. So when we look at this December cotton, it's going to be important for a lot of folks. Cotton is a big book of what we carry at AgriSompo North America. Far higher percentage than what a lot of Midwesterners think, but it is a capital intensive crop, and it makes up a large percentage of our book. So we better touch on it here.
Well, taking a look here, we can see that January ending stocks got cut back a little bit from where they were in December. They were basically put back to where they were in October and November. Yields were raised a little bit, but harvested acres were shaved meaningfully, and that in turn took production down. As far as exports go, they cut that a little bit. Domestic use remains. If we could add just anything to this, if we could get this to 210, 220, that would help move this market a little bit. Or it could be exports too, but I'd like to see this number improved. That's something that could help, provide a little bit of floor and a little bit of bullish impetus to the cotton. China's purchases of cotton, we had a pretty good period. The exports to cotton, when I did the export sales report, which will be coming out tomorrow, exports of cotton to China have been really good. They have been one of the few bright spots. And if they can continue to, we can see that, we can amp that up a little bit. That's something that can be supportive to cotton. We're going to need to see a shift, though. If we forced everyone to go into an office, or most people back into an office, that's something that would help this out a little bit.
Let's look at that supply and demand table. It's not something a lot of us, I have the numbers on the tip of our tongue, but if you've got that handy, let's pull that up, Sterling.
For what?
Cotton.
Here, let me stop sharing that. Sure, here, let's see, let's bring that up here. Let's see. Boop. There you go.
So again, it's probably not a coincidence with what Sterling's showing you on charts, but slightly less ending stocks than what we had projected there in December. And when we look at plantings, that 10.23 million and harvested at 7 and 8, that 7 harvested number was considerably lower. Sterling, in your crystal ball, what do you see for cotton plantings 2024? And if they're lower, what commodity takes their spot?
I'm going to put cotton planted. We were 1023. We were 1375 back in 22-23. And if you notice here, our ending stocks were 425. We're down to 290. That's generally supportive. That's a good thing. I don't think we're going to get back to this big number. I think we're going to take this number for cotton acres. Let's just call it 11 for now, and we'll see. There may be some soybeans that go in where cotton was traditionally planted with people who can do that. We'll see if we can get a rally in soybean prices coming in. That may influence some decisions.
Interesting.
So we may be seeing a little bit of a structural change where we see fewer acres of cotton. Once you switch out of cotton and start moving more into soybeans, switching back becomes you become a little less flexible. So again, there's going to be a lot of local factors, soybean basis in the South, things of that sport could help prompt that and help keep these acres a little bit tamer. And that in turn should increase market volatility, increase some upside risk.
Yeah, soybean basis in the South has been something that a lot of those Delta farmers have lived off of, especially when you can harvest those beans as early as August. And not a coincidence. That's the gap that we need to fill in the export race.
Right.
Brazil's largely out of beans by that time, and there's that strong demand for early U.S. beans. And it makes a lot of sense that if you're not going to plant those cotton acres, to put those in beans, try to get them planted as early as you can, try to get them delivered as early as you can. And it's brought really nice premiums. Those basis levels have been as high as $1.75 over the last 2 August. So makes a big difference whenever we talk futures around $12. Nice to add that basis to them.
Yeah. So that's something that I think can be a little bit favorable to cotton. We need to keep the consumer healthy. That's obviously job one. Along with that, if we could see things like boxed beef prices and things, food prices ease a little bit, which there are some nascent signs of, but I wouldn't count on it easing too much. Price of food and a lot of these other labor intensive consumer goods, they're never going back to 2019 levels. That's just not going to happen. The cost of the labor has moved up, and labor costs tend to be pretty sticky. The ability to automate a lot of that really isn't going to happen that much. So we can avoid, a recession and things like that. That's something that could be something that's potentially bullish for cotton prices.
Well, I can see the tone of this meeting changing just a little bit as we go through it. That there's the bottom line is, and Sterling said it earlier, these bear driven markets, they still have opportunities. You just have to really work hard to identify them. And the common denominator in everyone I've been through, and I shouldn't say everyone I've been through, the bullish driven markets that we just came out of, folks, they're the exception and not the norm. Sterling and I have lived most of our careers through this type of marketplace. And you do have those 5 days like we talked about on corn. It may be 2 days, it may be one day. The key is identifying those, and little things like Jody pointing out, 12.95. Sterling pointing out the stupid offer, the RSI, the indicators that we've rolled out. We have to make that our bread and butter when it comes to marketing, because let me tell you, if beans go to 12.95, how many farmers are going to be elated with that price? Zero. If corn advances back up to $5, how many farmers are going to be jumping for joy at $5 corn? Zero. But we have to recognize that we've had a fundamental shift in these markets, and it looks like it's here to stay for a while. Not that there's not opportunities. There's just not daily opportunities like we enjoyed over the last 36 months.
As long as those balance sheets and global supplies stay heavy, the markets will stay heavy. That is going to be an inescapable reality, but that doesn't mean we're not going to get pops and chances. And it requires a little bit of bravery. You have to be willing to. I really want 13.50 for my beans, but 12.95 is a lot better than 12.02. And we kind of have to accept that reality. And we also don't second guess yourself. You sold some and then the beans go up more. Don't necessarily feel bad about that. That's because you don't know in a bear market when the buying is going to abate, because it abates very quickly. And the market will fall right back in. That corn chart is a beautiful picture of that. And there is apparently, and we're going to share one more chart here real quick. There is something going on in the world. I don't know what just yet. This is an everyday chart of crude oil. This is what crude oil has done since we started this meeting. Something is going on and pushing that higher. And just maybe we can start the reversal process in the beans. And if you remember looking at those charts, it takes 2 or 3 days to amp up. The big opportunities last about 2 or 3 days, and very often come right back when that news wears out, or those funds have covered whatever shorts they are inclined to cover.
I'm going to peruse the headlines real quick, Sterling, to see what we might be facing here. Haven't seen anything come across my flash news.
Let's see what I've got here. Crude inventories now 2.49 million barrels. So these crude oil inventories had been building. We did get, a sign that maybe they're backing off a little bit. Some of that's holiday seasonal activity. but we also saw imports come up. So maybe domestic supplies tightening just a little bit. And the crude oil market is going to be horribly sensitive to everything like that. And that is something that, that is something that can change things a little bit.
Indirectly, we got to look at this weather too. And across Europe, across North America, December was abnormally warm. And so consumption for a lot of our energy products was low. And of course, if you're listening to this and you're anywhere, I think anywhere north of the Gulf of Mexico, you're probably bundled up and cold. And so consumption, by the nature of it, is definitely going to increase in January.
And here, just to reiterate how bear markets bounce, I have the best picture of this in real time, news driven. This is, here, let me share this very quickly here. This is a chart of natural gas. Do not try to trade this on your own. Here we were drifting in a dead bear market. We have taken natural gas prices right into the tank. This is what a cold forecast did. And the amount of this bounce, it doesn't look that big on this chart, but in terms of percentage, we bounced in a very short period of time. That is 33%. So again, pay attention. And right now, assume that we're, anything that better than the prices we have today is a better deal for you. You just have to kind of approach it that way until we start to see something mess up. My guess is if I were going to pick one item, it'd be South American weather next year. So, Brooks, did you have anything that you want to add other than talking about the action indicators that we've added for everybody?
Let's throw the action indicators up here if you've got those handy, or I can throw them up there. I've got them.
You can go right ahead. That's on the big right-hand computer.
So. All right. Well, I'll switch over here and we'll take a look. Bear with me just a second as I pull these up. So we want to share screen. Talk to myself through this like an old guy. Let's see. So the action indicators, and Sterling and I are really going to do some internal training with AgriSompo. These are something that we've had in the past. We've changed them just a little bit, and I like some of the changes that we've made. We discontinued these in 2020. As a matter of fact, about April and May of 2020. And the reason that we did is the goal of the action indicator is to pick the right environment from a historical perspective that gives your farmer some insight as to when to sell their crop. So in other words, we want the premise behind this is we've got 4 things that we measure. There's 4 variables. We want 3 or 4 of these 4 to trigger or turn green at the same time. And what that does, it's a simple mechanism that says, Mr. Farmer, historically speaking, it's a good time to sell. Now, we suspended these in 2020 because guess how many days, Sterling, these indicators triggered in 2020, 21, 22, and most of 23?
Every day.
Every day. So essentially, it was a good day to sell by historical means every single day. It really didn't give that farmer the advantage of knowing when to sell. We talked about a fundamental shift in these markets, and we brought them back, and we think they're going to be more valuable to us now than they have been over the last 3 years. The 4 variables, and I've got corn pulled up here. RSI. You guys are old hat at RSI because we've talked about it all meeting. But we look for any opportunities above 60. Now remember, RSI goes from 0 to 100. We're measuring that momentum in the marketplace. Yesterday we were at 22.6, I believe, on corn. Sterling said we're a smidge higher than that today. That's one thing that we look at. RSI 60 plus, between 60 and 100, we trigger that mechanism or that indicator good time to sell. You can see it's red and it's low, not a good time to sell. Spec funds, Sterling, when someone who hasn't seen or even knows what a kernel of corn looks like decides to put millions of dollars in your marketplace, farmers need to take it upon themselves to do what?
Take advantage of that opportunity. When Wall
And
Street
so
hands you money, you take it.
you can see how this whole package comes together. On Friday, we have a weekly wrap up. Sterling talks about those spec funds on Fridays, the spec fund positions. We're short on corn. When we're short, our fuel tank is below half to empty. It's not a good time to be a seller. We need to wait until those spec funds buy our commodity. They put their money in our market. Pretty simple concept. Not a good time to sell right now. This third one, I'm lukewarm on it, to be honest with you, but we needed something objective out there. And I'm gonna throw you a disclaimer right now. All of these things are available for free. You can look these up independently. Any farmer can look these up. All we've done is simply package them together. So there's no magic wands here. It's just some basic indicators that Sterling and I look at that we just wanted to share. But I looked at gross income, really a challenge. I use 185 bushel the acre yield, and 475 December futures. I think we're a little lower than that now. We want to simply multiply those December futures times 185, and we're trying to achieve that $1,050 gross dollar level. And where we got that, we just really kind of looked at some Midwestern states, and that gives you a little profit on top of your direct and indirect cost out there for most farms. I know if you're in the South, if you're in the Dakotas, your costs aren't quite that high. You can kind of tweak that, but we just needed some type of baseline that was out there. And you can see we don't have that gross number. We didn't trigger. And stochastics, Sterling talked about this. And that's something that we'll probably do more education on as time goes on. He showed stochastics on corn earlier. They remain an oversold and a bearish configuration, and that's something that that can change probably the quickest of all these. Stochastics can change. So if I was guessing, if I saw something triggering on here quickly, it may be that stochastics, and then we have to look for things like RSI, and hopefully that RSI comes up. Spec funds have got a lot of buying to do before they get back to that even position or long. So don't look for any 3 out of 4 triggers anytime soon, but we're monitoring things. I think these are going to be a big asset to your agency or to your operation if you're a farmer listening. I'll show beans on here, Sterling. You got a couple comments?
Yeah, and if you want to learn more about how these actually work, the Tech Tuesday newsletter are these indicators, and basically they're taken apart. You can see a seasonal picture of where the fund position is. When I look at fund positions, I look at what they are overall, but I also look for where they are for a given time of year, because for the grain markets, it truly matters. It doesn't matter one bit for the bonds or the S&Ps, but it does matter greatly for the grain market. So if we have a seasonal short, it may not be a record, but if it's that time of year, that can definitely matter. Also, the RSI indicators are on, and the stochastics are on those charts, and you can look at those. If you have any questions, I can explain the mechanics of them to you. But what the stochastic, why we added this is it's a precision indicator. The RSI is a general indicator. The stochastic will give buy and sell signals. The reliability is good, but it's also something I know that the guys on Wall Street are looking at. So that's something to try. And right now, we're just hoping for better prices, and better prices will come eventually. When we have good prices in raging bull markets, then we sharpen the pencil, and we're not aiming to put the ball on the green. We're aiming to get down in 2 and trying to hit the hole a little better, because the market will be higher and percentage moves are inherently bigger. And I have some good news. Corn is now positive on the day.
No, I don't believe it. I don't believe it. No.
442 and 3/4 up a half a cent.
So
we recovered 6 cents on that bouncing crude oil.
Well, I think it was due to the marketing meeting, but you call it crude oil if you want to, Sterling.
Well, and soybeans for March, 1206.5, now up 3/4. We made a low at 1201, which is that key support area. And again, that's why the DMO looks a lot different from what it used to because all these markets are deeply interconnected. And a problem in one place will reflect itself elsewhere. And the bad news
Sterling,
is
we've been at this. I look down and we've been at this an hour and 15 minutes. So we probably need to let some folks go on with their day. It's I think a lot of things. I will throw this out there, but everybody feels like their back's against the wall. It's no fun to be an agent right now because, as I mentioned earlier, we're in that no man's land on crop insurance. The good thing is you rely on crop insurance more in these types of markets. There's no doubt about it. But just being there for your farmer, talking him through these situations, it's key because what happens is when you're alone out there and you're marketing that crop and you see this corn market that's dropped day after day after day after day, um, you know, eventually, because of the need for cash, they're going to sell. And we need to at least offer some alternatives out there, whether we're right or we're wrong. You need to offer some opportunities that gives them some peace of mind that I haven't sold at the bottom of this market, and um, haven't sold at the bottom of this market. And if there's a bounce, I can get something there. So, with that, Sterling, I'll let you take us away.
make sure to read the market outlooks every day and listen to the podcasts. As again, we're in the spot where my old boss at Citibank said, have your head on a turret and be ready to go. Because these opportunities, there are going to be some. They're not going to be huge unless we see a big change in a weather pattern, but they will be there, and we have to be alert and ready to take advantage of them. So with that, I think this concludes the third Thursday marketing meeting for January, and I'd like to thank everyone for their time, either in attendance or watching us today. If you have any questions, certainly feel free to reach out.
Thanks, everybody. Bye bye.